Welcome to this complete beginner's guide on how to start investing in real estate in the United States. If you've ever thought about building wealth, creating passive income, or escaping the paycheck-to-paycheck grind, real estate might just be your answer. But let's be honest, it's a big, complicated world. You've got terms like cash flow, cap rate, refinancing, and equity flying around. You might be asking, where do I begin? Do I need a lot of money? Isn't real estate risky? Don't worry. In this video, we'll break everything down in plain, simple language. You'll learn how real estate investing works, what strategies beginners can use, how to find good deals, how to get funding, and most importantly, how to take action without getting overwhelmed. We're going to walk step by step through real examples, expert tips, and the tools you need to start your journey today. Whether you're 18 or 58, full-time employed or freelancing, there is a way for you to start building your future through real estate. So grab a notebook, get comfortable, and let's dive in. By the end of this video, you won't just understand how real estate investing works. You'll be ready to get started. Let's start with the basics. What exactly is real estate investing? At its core, real estate investing means buying property with the goal of earning a return. That return can come from rental income, value appreciation, or profits from reselling. Unlike stocks or crypto, real estate is a physical, tangible asset. People will always need places to live, work, and shop. Now, there are four main types of real estate. Residential. This includes houses, condos, and apartment buildings. It's where people live. This is the most popular starting point for beginner investors. Commercial. Think of office buildings, shopping malls, and storage units. These usually involve larger capital and more experience. Industrial. Warehouses, factories, and distribution centers. Not common for beginners, but highly profitable for niche investors. Land. Raw land can be held for appreciation, used for farming, or developed into something else. Now let's talk about different ways to invest. You can be an active investor, meaning you buy, manage, and possibly renovate properties yourself. Or you can be a passive investor, like putting money into a REIT, real estate investment trust, where a company owns and manages properties and pays you a share of the profits. There are also different strategies, which we'll break down in detail later. But in simple terms, you can buy and hold, buy a rental property, rent it out, and earn monthly income. Flip houses, buy a property, renovate it, and sell for profit. Wholesaling. Find deals for others and earn a fee. BRRRR. Buy, rehab, rent, refinance, repeat. Each has its own level of risk, work, and reward. So, why do people love real estate? Here are a few reasons. Cash flow. Steady monthly income from rent. Appreciation. Property value often rises over time. Leverage. You can borrow money to buy bigger properties. Tax benefits, depreciation, deductions, and 1031 exchanges. Control. You can directly improve and manage your investment tangible asset. Unlike stocks, it's something real you can see and touch. Real estate investing is one of the most reliable paths to long-term wealth, if you learn and take action wisely. Now that we understand what real estate investing is, let's talk about why the United States is one of the best countries in the world to do it. Whether you're a U.S. citizen or a foreign investor, the U.S. real estate market has powerful advantages that make it both attractive and accessible. Let's break it down. 1. Strong legal system for property ownership. The U.S. has one of the most secure and transparent legal systems when it comes to owning property. When you buy real estate, you get a deed and title that's protected by law. You can research who owns the property, what taxes are owed, and any legal issues before you buy. That level of security gives confidence to investors from all over the world. 2. Access to financing. Another huge advantage is access to leverage, which means using borrowed money to buy an asset. In the U.S., banks and lenders commonly offer mortgages, loans that allow you to buy property with only 20%, 10%, or even just 3.5% down. That means instead of buying one property with $100,000 in cash, you could potentially buy 4 properties with $25,000 down each. And if the property generates income, that income can help cover the loan payments, multiplying your returns. 3. Tax benefits. The U.S. tax code actually rewards real estate investors. Here are just a few benefits. Depreciation. You can deduct part of the property's value from your income taxes each year. Mortgage interest deduction. You can write off the interest on your loan. Repairs and maintenance. Most everyday expenses related to owning rental property are tax deductible. 1031 exchange. You can sell a property and use the profits to buy another without paying capital gains taxes right away. These benefits can drastically increase your after-tax income and wealth over time. 4. Strong rental demand. There's always someone who needs a place to live. Whether it's students, young professionals, families, or retirees, demand for housing is high, especially in growing cities and suburban areas. People are renting longer than ever before, and remote work is reshaping where people want to live. That opens up new markets and opportunities for smart investors. And in some areas, rental income far outweighs expenses, creating positive cash flow from day one. 5. Appreciation and long-term stability. Real estate values in the U.S. generally go up over time, especially in desirable or growing regions. Yes, markets go through cycles, but long-term investors tend to benefit from appreciation over decades. Even during recessions, real estate has often proven more stable than stocks. It doesn't crash as fast, and it often recovers quicker. If you buy smart and hold long enough, history shows that property value tends to rise, especially when the property is well maintained. 6. Global appeal. Investors from Canada, China, the UK, India, and beyond have been pouring money into U.S. real estate for years. Why? Because the U.S. offers transparency, access to data financing options, strong returns. This global demand helps keep the market competitive and liquid, meaning it's easier to buy and sell properties compared to some other countries. All right, now that you understand what real estate investing is and why the U.S. is such a great market, let's dive into the strategies you can actually use to make money in real estate. There's no one-size-fits-all approach. Some people want quick profits. Others want long-term passive income. Some have money but no time. Others have time but little money. So here are the top strategies for beginners, explained clearly so you can figure out which one suits you best. 1. Buy and hold. This is the most common and beginner-friendly strategy. How it works. You buy a property, usually a single-family home, duplex, or small apartment, and rent it out to tenants. You collect rent each month, which ideally covers all your expenses and leaves you with extra income. Your profit comes from monthly cash flow, property appreciation over time, tax benefits. Why it works. It's slow, stable, and powerful. Over time, your mortgage gets paid down, the property gains value, and your cash flow increases. Who it's for. Perfect for long-term thinkers who want to build wealth and passive income. 2. House hacking. If you're just starting out, this strategy is a game changer. How it works. You buy a duplex, triplex, or even a single-family home with a basement or extra room, and you live in one part while renting out the rest. Your tenants help pay the mortgage, and in many cases you live for free, or even earn a little money. Example: buy a fourplex with an FHA loan, 3.5% down, live in one unit, rent out the other three. You get rental income, tax benefits, and a property that grows in value over time. Why it works. You combine homeownership with investment while living affordably. Who it's for. Perfect for young professionals, students, or anyone who wants to start with low risk and low money down. 3. The BRRRR method. This stands for buy, rehab, rent, refinance, repeat. How it works. Buy a distressed or undervalued property. Rehab it. Fix it up to increase its value. Rent it out to solid tenants. Refinance the property based on the new higher value. Repeat the process with the cash you pulled out. You basically recycle your money to buy more properties without saving for a new down payment each time. Why it works. It builds wealth and equity fast, and if done right, you get your money back out after each deal. Who it's for. Investors who are comfortable with renovations, managing contractors, and dealing with banks. 4. Fix and flip want. Faster returns? This one might be for you. How it works. You buy a property that needs work, fix it up quickly, and sell it at a profit. Ideally within 3 to 6 months. Your profit comes from buying low, adding value through renovations, and selling high. Why it works. You can make tens of thousands in just a few months, if you do it right. Risks. Flipping is more speculative. It depends on timing, market conditions, and renovation budgets. Costs can add up fast if you miscalculate. People with construction knowledge, good budgeting skills, and time to manage projects closely. 5. Wholesaling. This is a popular strategy for people with little or no money to invest. How it works. You find a great deal on a property. You sign a contract to buy it. Then, you sell that contract to another investor for a fee. You never actually buy the property yourself. You just get paid for finding the deal. Why it works. No capital, no credit needed. Just hustle, networking, and negotiation skills. Who it's for. Beginners who want to learn the market, build cash, and eventually move into buying properties themselves. 6. Short-term rentals, Airbnb, VRBO. Instead of renting monthly, you rent nightly, like a hotel. How it works. Buy a property in a tourist-friendly area and list it on Airbnb or similar platforms. You make money per night, and the income can be significantly higher than long-term rents. Pros. High cash flow potential. Flexible usage. You can use it too. Furnished rentals often earn more. Cons. Seasonal demand. High management and cleaning needs. Local laws and regulations. Who it's for. Investors in vacation destinations or cities with strong tourism, willing to manage or outsource hospitality operations. 7. Turnkey properties. Want to invest without all the hands-on work? How it works. You buy a fully renovated tenant-occupied property from a company that does everything, from rehab to property management. You just collect the rent. Pros. Hands-off investing. Instant cash flow. Cons. May pay a premium. You rely heavily on the provider who it's for. Out-of-state or international investors who want simplicity over maximum profit. 8. Real estate investment trusts, REITs. Don't want to own property at all? This one's for you. How it works. You buy shares of a REIT, a company that owns income-producing properties, just like buying stock. Pros: super liquid, buy, sell anytime. Diversified exposure. No landlord duties. Cons: less control. Subject to stock market fluctuations. Passive investors who want exposure to real estate without owning physical property. As you can see, there's a strategy for everyone. Whether you're broke or loaded, busy or hands-on, young or older. The key is to pick one strategy, learn everything you can about it, and take small but consistent action. You don't need to know everything before you start, but you do need to start. So you've chosen a strategy. Now, where do you invest? Many beginners make the mistake of only looking in their local area. But the best deals might actually be in a different city or state. Here's how to choose the right market. Checkmark 1. Look for job and population growth. The best markets for real estate investing are growing. More people, more jobs, more demand for housing. Look for cities or suburbs with new employers moving in, low unemployment, rising population year over year. When people move in, rents rise and property values increase. Examples: cities like Austin, Charlotte, Tampa, and parts of the Midwest have seen strong growth in recent years. 2. Check rent-to-price ratio. A good rent-to-price ratio means you can cash flow, that is, earn income after paying expenses. As a rule of thumb, if monthly rent is at least 1% of the purchase price, it's worth investigating. Example: a $150,000 home renting for $1,500 a month is solid. In expensive areas like California or New York, this ratio is often too low for investors, but you can find better ratios in the Midwest and South. 3. Analyze supply and demand. High demand and low supply equals strong rental income. Check. Rental vacancy rates. Lower is better. Construction activity. Too much new supply can hurt rents. Affordability. Is housing still within reach for local income levels? 4. Legal and tax environment. Some states are more landlord-friendly than others. For example, Texas and Florida favor landlords. New York and California have strict rent laws and tenant protections. Choose a state that aligns with your risk tolerance and management style. Also, check property taxes. They vary greatly by state and county. The right market balances affordability, growth, and cash flow potential. Don't chase hot markets blindly. Run the numbers and understand the local economy first. So you've found a market. Now, how do you know if a specific property is a good deal? Here are the core numbers every investor needs to understand. Checkmark 1. Cash flow. Cash flow is the money left after all expenses. Formula: cash flow equals rental income minus expenses. Expenses include mortgage, property taxes, insurance, maintenance, property management, if any, vacancy allowance. If cash flow is positive, you're earning money monthly. If negative, you're losing. 2. Cap rate, capitalization rate. Used to compare properties across markets. Formula: cap rate equals net operating income divided by purchase price. Example: if a property earns $12,000 net income yearly and costs $200,000, the cap rate is 6%. Higher cap rates usually mean better return, but may come with more risk. 3. Cash-on-cash return. Tells you how much you earn on the money you invested. Formula: cash-on-cash return equals annual cash flow divided by cash invested. If you invested $40,000 and earned $4,000 per year in cash flow, that's a 10% return. 4.1% rule. Quick filter. If a property's monthly rent is at least 1% of the purchase price, it may be a good deal. $150,000 home should rent for $1,500 per month or more. Run your numbers before you buy. Don't rely on emotion or gut feeling. Real estate is a business. Treat it like one. You don't need to be rich to invest in real estate. Most investors use other people's money through loans. 1. Conventional loan. The standard bank mortgage requires 15 to 25% down for investment property. Best if you have good credit and steady income. 2. FHA loan for house hacking. Only 3.5% down, and you can live in one unit and rent out the others. This is how many first-time investors get started. 3-point VA loan for veterans. 0% down for military members. An excellent tool if you qualify. 4. Hard money loans. Short-term loans used for flips or BRRRR. Higher interest, but faster and easier to qualify. 5. Private money and partnerships. Borrow from family, friends, or investors who want to earn returns and split profits. Build your credit, keep your finances clean, and talk to lenders early. Financing is just a tool. Learn how to use it. Real estate is a team sport. Here's who you need. Real estate agent. Helps you find and buy deals. Lender. Provides financing. Property manager. Handles tenants, rent, and repairs. Contractors. Renovate and repair properties. CPA/accountant. Handles taxes. Attorney. For contracts and legal protection. Choose people who understand investment real estate, not just regular homes. Network online and locally. BiggerPockets.com, Facebook groups, and real estate meetups are great places to start. You'll want to protect yourself and your assets. LLC or not. Many investors use LLCs, limited liability companies, to own rental properties. Benefits. Protects your personal assets from lawsuits. Keeps things professional, can offer tax flexibility. Talk to a CPA or real estate attorney to see if it's right for your situation. Bookkeeping and taxes. Keep detailed records. Rent collected. Expenses, paid repairs, upgrades, mileage, etc. You'll get tax benefits like depreciation, deductions for mortgage interest, insurance, and travel use software, or hire a pro. Real estate taxes can save you thousands, if done right. Let's help you avoid beginner mistakes. 1. Not running the numbers. Hope is not a strategy. Analyze every deal with real math. 2. Overpaying. Don't chase hot properties emotionally. Stick to your criteria. 3. Underestimating repairs. Always budget more than expected. Surprises are common. 4. Doing it all yourself. Hire pros where needed. A good manager or contractor is worth the money. 5. Waiting. Too long to start. You'll never feel 100% ready. Start small, but start smart. Knowledge is great, but nothing happens unless you take action. Here's your simple 5-step game plan. Pick a strategy. Choose one that fits your budget, time, and risk level. Choose a market. Find a city or area with growth, demand, and solid returns. Build your team. Network and connect with an agent, lender, and contractor. Get pre-approved. Know your budget and financing power. Start analyzing deals. Look at real listings, run the numbers, and make offers. Start by looking at just one property per day. Practice running numbers. You'll build confidence fast. Remember, most successful investors aren't the smartest, just the most consistent. Real estate isn't a get-rich-quick scheme. It's a build wealth over time plan. It's one of the most powerful tools for financial freedom, but only if you take that first step. You don't need to know everything. You just need to get in the game. Start small. Make mistakes. Learn. Grow. Repeat.